Hi everybody and welcome to the Middle Class Investor this week. This is Seth Martin. It is January 7th, about 3:30, and this is my second recording, so I'm going to be a little less winded. The first recording I had an audio problem with and it's discarded. So maybe this one will be better, but it's definitely going to be shorter because there's not much going on except just bullishness in the U.S. equity markets, and more bullish in Bitcoin and all that kind of stuff. So what I did is I have a chart of the Wilshire 5000. This is from Deneric's website, and he does a pretty good job of charting the markets. One of the things I'll note here is that as we've been going up through this wave 5, even though the price and you know, I know that we get paid on price, so but sometimes what you have to look for is divergences, and divergences a lot of times occur in these last wave positions. So you can kind of see the momentum is falling in the market as the market rose here to new highs. And the reason he uses the Wilshire is just because it's broader. It's got 5,000 stocks, and you know, for charting, he thinks it's you know, a better thing to use. But this particular trend is 3 degrees of trend. It goes back to, if I can show you here, it goes all the way back. You can barely see here to February 2016, where it ran up pretty violently and has been coming up ever since. Of course, when Trump got elected, which is right in here, it really started to shoot up and kind of take off and go to the moon. So that's where we're at right now. Okay. So if we look at what I've got, what I'm looking at here, again, I have to pull up my charts, re-pull up my charts because I was finished on that one earlier. Let's look at the S&P 500 index. That's what this is. All right. So one of the things you can see here on the S&P 500 index is that, you know, we're in a throwover at this degree of trend. We're in a throwover at this little degree of trend here. And then this little lesser degree of trend, we're not quite in the throwover yet. So, you know, what does that mean? Well, it might mean that the market goes up a little higher next week and then turns around and sells off. So maybe expect some bullishness early in the week, and then maybe some bearishness later in the week or midweek, maybe starting on Tuesday late. So that's what I'm going to be kind of looking for. Let's look at some of the things we normally look at. We look at volatility, CBOE volatility index, and volatility has been low. It's not been as low this past week as it was in previous weeks, but still very, very low given where we're at. And you can kind of see the downtrend line here, and I guess until this downtrend line really breaks, I mean, we should expect volatility to continue to be low. But according to Deneric's chart and according to some of the other anecdotal evidence, that it's not really anecdotal, it's more like usually when everybody starts getting bullish, I think I've used this analogy before. It's like if everybody was in a boat and everybody got to one side of the boat, well, the boat flips over, and that's kind of what happens in the market. And right now, it seems like there's a lot of people. I mean, there's just no bears. In fact, even the bears that have been bears for a long time have abandoned their bearish position and started talking about bullishness. So everybody is on board with the bullish uptrend, and you know, this bond market is part of it. Last week, you know, the 10-year was up, but so was the 2-year. And a lot of people look at the spread between these two, and it was only 48 basis points. And so, you know, when this 2-year really starts to take off and leave the 2-year behind, that spread will continue to increase. But last week it was just kind of odd that it actually contracted a little bit. And that even led more to bullishness. People were like, oh, this is great. We're going to have low interest rates for even longer than we anticipated. So anyway, it's just another reason to be bullish, basically. But a lot of these charts tell us different information. They tell us these are bear traps. Where it just sucks in the last few holdouts, people that are holding out for that have been bearish, that are finally capitulated and said, nah, that's it, I'm bullish now. So it's almost like in the investment industry, really, if you're a professional investor, if the S&P 500 is up 25% and you're up only 20%, then, which is what happened to a lot of people in 2017, you start to lose money. People start to close their accounts. So you always have to outperform the S&P 500. And if you're also someone who's bearish and you didn't outperform the S&P 500 last year, a lot of people will pull their money from you. So what ends up happening is, kind of at these late stages, people become bullish, and then they say, well, you can't blame me. Everybody was bullish, kind of thing. It's not my fault. Everybody was bullish, and that's kind of what you get. But here's the 10-year Treasury. You can see the yield kind of pulled back here a little bit. It's got a rounded bottom. This is kind of what's known as a cup and handle. Here, I'll just draw it real quick. So this is kind of the cup. It kind of goes up like that, and then it pulls back and makes a handle. And you can see here that now typically the cup and handle is not confirmed until you get a close above, that most recent high, which is right here. But this is a classic cup and handle. Here's another one right here. I mean, if you really start looking for these things, you can see them everywhere. You can see the cup, the little handle pullback. Of course, the pullback on this lasted longer, but you can see this cup and handle was confirmed right here. Then we got a second pullback. Sometimes this happens when you're getting when there's some momentum building. So in other words, this could be like a 1-2, 1-2 kind of thing, and then 3. So we'll just wait and see, but suffice it to say, people are using the bond market to justify their bullish position, and I think what you had last week's kind of unusual. You had the 10-year and the 2-year going up, which closed the gap between the two. A lot of people look at the difference between the 2-year and the 10-year, and I think last week it was at about 50 basis points or a little bit lower. So people look at that and go, oh, wow, the Treasury yields are going to be lower for a lot longer than we thought. Maybe, but it could just be that, the short end is catching up to the long end, and the long end's fixing to really take off. So we'll just have to see. But I just thought that was interesting. I usually don't hear, that much talk about the spread between those two. The rest of the world, no different than what we're experiencing here. I mean, everybody's bullish. That's Germany. That's Japan. This is Japan coming up. This is Japan. So very bullish, went above its DP area. Now, so what's next for Japan? What's the next area where the Japanese market could be concerned? And really, this EWJ is probably not the best instrument for that. As you can see, it only goes back to, maybe you can see 1991. And, the Japanese market was way up here before that. So, you could look at a DP off of this area, maybe one like this. But even that, it's still kind of above it. So, I don't know. I mean, it just could be the function of the ETF, but everything's very bullish right now. There's no doubt about that. let's go to 5 year. That way you can look at weeklies. And then here's the United Kingdom. It's also bullish, broke its downtrend line. If it will pull up, there we go. So here's it broke out of this uptrend line, which is, I would say, is probably pretty bullish. So even though it was very choppy right in here, it's since, here's kind of a cup and handle, pull back, take off. So I don't know. It's hard to say, but like I said, it's like a boat. When everybody gets bullish, at some point it's going to tump over because the market can't sustain that many people. The other thing I noticed is on, let me see if I can pull it up real quick. I noticed on Shadow Trader, so this is another thing I follow. On Shadow Trader, they were talking about how the ticks, for the last couple days, the ticks and the tick is like the smallest, measurement you can have in the market. Well, I'm not on here enough to really know how to navigate it, so I apologize. It was on Twitter that I saw. Let me see if I can go Twitter/Shadow Trader. Peter Resnick. So I make sure I get what he actually said. So what he said here is new all-time highs again, and the NYSE tick was only plus 184, and cumulative tick flat to negative all day. I know all about staying irrational longer than solvent, but this is beyond the pale. So basically what he's saying is, even though the market was charging higher, you got this kind of situation. So the volume wasn't there to support it, the tick volume or the ticks themselves. And so that's an unusual situation in the market. You don't normally see that, but that's not unusual when everybody's on one side. Okay, there's no opposing force, and so when everybody's on one side, it doesn't take that much buying pressure to push the actual price value higher. And I think that's probably what Peter's alluding to there. All right, let's look at the year. We'll look at the euro US dollar. The dollar pushed a little lower last week, which made the euro continue to push higher. The EWI guys are saying that that the dollar's really close to turning, and that may be. I don't know, but excuse me. If the dollar does turn upward, then we should get a corresponding down move here in the euro. Also in the British pound US dollar, if the dollar moves up, then the British pound US dollar should move a little lower, which would be great because I think this is a great buying setup here, but we need a pullback in order to get into it. I think the British pound looks pretty bullish, and the reason I do is because you have this huge ABC here, and usually that's usually a very bullish position. But what we want to do is we want to see it pull back, pretty deep here, so we can have our reward to risk can be much greater. All right, let's look at oil. Oil has been, like it was shot out of a cannon here recently, and it did make it up to our DP. A lot of oil stocks too. I looked at a number of oil stocks, and they look pretty long on the tooth. So I would look for oil. It may go a little higher here, but I would look for oil, in the intermediate term to start turning over and going lower, which could correspond with an increase in the dollar. If the dollar really takes off, you should see oil roll over as well. On gold, gold has been going up for several weeks. We were talking about it a few weeks ago about being right in here, and is it going to go down here first, or is it going to turn up and go up here first? It looks like the latter is going to happen, although it could come down next week and the week after a little bit, and then kind of make its run up into our decision point area. But I think the risk of it going much lower than this low right here near term is probably probably low right now. I think it's going to make it all the way up here first before it rolls over. So you might see oil pull back a little bit, maybe into the 1280 area, and then start to turn back up, come up here into the 14+100 area before it has another move big time down. So that's about it for this week, everybody. I've already, like I said, I went through this one and my audio was screwed up, so I had to redo it. But there's really not much to say other than there's just a lot of bullishness in the market. There's a lot of talk like this is great, it's never going to go down, and usually when you start hearing that, you know your spidey senses should perk up and let you know that there's something not right about that, and you should start looking to take some risk off the table. It was just one last check here to see if there's anything I was missing. The 30-year Treasury, let's see what the 30-year Treasury, yeah, it was up too, but pulled back into this range a little bit. So I would say, keep a close eye on the 10-year yield. The 10-year yield right now at this very moment is 2.476. So I would start paying close attention. If it got up above 2.5 again, it's probably going to just keep going, probably all the way to 4. So that's it for this week's Middle Class Investor. Everybody, thanks for coming in, and hope to hear you next week. Hope you're forwarding this to your friends and family, and maybe you don't want to do it right now because I'm still talking about being bearish and the market's still going up, but that will change soon enough, I promise you. So keep a list of the people that you want to forward the YouTube channels to, and let's keep our friends and family from losing tons of money. All right, thanks everybody. Talk to you later. Bye bye.